The IFRS 11 is the accounting standard for joint arrangements, issued by the IASB. It replaced earlier guidance including IAS 31 and SIC 13 to simplify and improve the rules. The standard's main goal is to set principles for financial reporting by entities involved in joint arrangements. It aims to enhance comparability between companies' financial statements, helping users assess joint business activities. IFRS 11 focuses on classifying joint arrangements based on the rights and obligations from the agreement, not just legal form. The substance of the arrangement is what matters most. This principle guides how companies account for joint arrangements. Proper classification directly impacts how assets, liabilities, revenues, and expenses are reported. Transparent application ensures stakeholders get a true picture of the business. This transparency builds trust and supports better decision-making. Understanding IFRS 11 is essential for accurate accounting. It lays the foundation for correct financial reporting. The classification of joint arrangements is a critical first step. Getting it right is vital for reliable financial statements. IFRS 11 defines a joint arrangement as a contractual agreement where two or more parties share control over an economic activity. Joint control means decisions require unanimous consent. No single party can act alone. This structure is common when companies want to access new markets, share risks and costs, or gain expertise and technology. Large, complex projects often drive the need for joint arrangements. Pooling resources, financial, technical, and human, can make ambitious projects possible. Collaboration through joint arrangements can lead to greater success than going solo. These partnerships help companies achieve economies of scale and drive innovation. Joint arrangements are essential for tackling projects too big for one entity. The shared expertise and resources often result in more effective outcomes. IFRS 11 ensures these collaborations are reported consistently. This consistency benefits all users of financial statements. IFRS 11 classifies joint arrangements into two types: joint operations and joint ventures. This distinction is fundamental, as it determines the accounting approach. In a joint operation, parties have direct rights to assets and obligations for liabilities. They're called joint operators. Each joint operator accounts for its share of assets, liabilities, revenues, and expenses directly. The focus is on individual items in their own accounts. In a joint venture, parties have rights to the net assets of the arrangement, often structured as a separate entity. These parties, called joint venturers, use the equity method to account for their interest. The classification impacts financial statements significantly. Errors in classification can mislead users of financial data. Careful assessment and judgment are required to get it right. The correct classification is a key area under IFRS 11. It ensures the financial statements reflect the true nature of the arrangement. Understanding these types is essential for proper application. The distinction drives all subsequent accounting decisions. The core of IFRS 11's classification is the rights and obligations arising from the contractual agreement. It's not just about legal form. A separate entity doesn't automatically mean a joint venture. In joint operations, parties have direct rights to assets and direct obligations for liabilities, including debts and expenses. They recognize their share of income and expenses directly in their accounts. This direct linkage is the hallmark of joint operations. For joint ventures, parties have rights to the net assets, not individual items. The venture, often a separate entity, holds assets and incurs liabilities itself. Joint venturers' interest is in the overall net position, usually accounted for using the equity method. The key difference: joint operators share in gross items, joint venturers in net results. This split drives the accounting treatment. Understanding these rights and obligations is crucial for correct classification. The assessment must consider all facts and circumstances. This ensures the arrangement is reported accurately. Accounting for joint operations means recognizing your share of assets, liabilities, revenues, and expenses directly. For example, if Company A owns 50% of a joint operation, it records 50% of the assets, revenues, and expenses in its own books. This is line-by-line recognition, reflecting direct rights and obligations. Joint ventures are different. Here, the equity method applies. The investment is recorded at cost, then adjusted for the venturer's share of profit or loss and other comprehensive income. For instance, if Company B owns 30% of a joint venture, it increases its investment by 30% of the venture's profit. dividends received reduce the investment balance. The equity method provides a single-line entry for the investment and share of results. This approach reflects the venturer's interest in the net assets. The accounting method depends entirely on the arrangement's classification. Accurate accounting ensures reliable financial statements. IFRS 11 provides clear guidance for both types. Proper application is essential for transparency. IFRS 11 applies to all entities that are parties to a joint arrangement, regardless of industry or size. The key requirement is joint control, unanimous consent for decisions. If one party has sole control, IFRS 10 applies. If only significant influence exists, IAS 28 is relevant. Arrangements without joint control, like simple supplier-customer relationships, are excluded. Some unincorporated partnerships may also fall outside IFRS 11's scope. The standard targets specific collaborative structures with shared power. IFRS 11 became mandatory for annual periods beginning on or after January 1, 2013. It replaced IAS 31 and SIC 13. Entities had to apply it retrospectively for comparability. Adjustments were made to prior period figures. The standard ensures consistency in reporting joint arrangements. Understanding when IFRS 11 applies is crucial for compliance. IFRS 11 brings clarity and consistency to accounting for joint arrangements. It ensures financial reporting reflects the true economic substance, not just legal form. This leads to more accurate and comparable financial statements. The standard helps management make informed decisions about collaborative ventures. It also aids in assessing risks and rewards, supporting better business planning. Accountants and auditors must carefully assess contractual terms and circumstances. Proper application is crucial for compliance and reliable financials. IFRS 11 promotes transparency and comparability in a global business environment. Its importance grows as cross-border ventures become more common. A solid grasp of IFRS 11 is essential for anyone preparing or using financial statements.